Welcome to the Gray Report. I'm your host, Spencer Gray. If you're a multifamily investor, whether you're an active investor, passive investor, just kind of casually interested in real estate investing, well, this is the best YouTube show and podcast designed really for you to help you make the most informed decisions. We're trying to bring all of not just information and general data, but the best pieces of information, the latest research reports, articles, original opinions, and content, anything revolving the multifamily industry, real estate, and the economy, again, so we can make some just better decisions going forward. Joined by Director of Communications and Marketing, Matt Bosnagel here once again. We've got a lot of stuff to go over. Not the least importantly is the Federal Reserve. Jerome Powell is at a press conference right now. We've been monitoring it. We're trying to bring you some of the latest information coming out of the Fed, the Federal Open Market Committee meeting. A lot to break down, but also reports from CBRE, multiple reports from Marcus and Millichap, NMHC, RealPage, and Apartment List. Let's get into it. All right, bringing it back in, Matt. It's an exciting day today. We got Jay Powell. He's talking right now, laying it down. Nothing really new. But before we kind of get into that, into some of the kind of really breaking news that's going to be moving, really macro economies, the economy, global economy.
Yeah.
Not just in the United States, but the Federal Reserve. They can be the limiter or accelerator on the economy. And we've had a lot of these macro discussions of, what are rising interest rates? How does that affect the market, and specifically real estate? And how does this slowing growth? Are we going to enter a recession, a technical recession? Mm-hmm. It's bred a lot of uncertainty and just a lot of dark clouds. But I think there's some green shoots and some positivity that we can look at as well, and what a lot of this means, because there's a ton of nuance to it.
Yeah.
And you can just be confused and uncertain, but I think there's some opportunities that we should be paying attention to. But first, before we get into that, how's your week going, Matt?
It's going pretty well. My kids' baseball game, they won. So
hey, there we go. Congrats. Is this like coach pitch, or is this like the T-ball, or what is it?
It is one above T-ball. They have a little catapult.
Oh, okay.
That throws the ball.
Very cool.
Yeah. So I think it replaced the dad's pitch.
Yeah, but the dads probably weren't very good, I don't know.
The same team pitches to each other, so there's no cheat.
Yeah. That's cool. All right, well that's awesome. Well, let's just get right into talking about what's going on over at the Federal Reserve. Because again, this is live when we're recording this. We're recording this May 4th, about 2:50 in the afternoon. So you're probably going to be watching this on Thursday or Friday, assuming that you are subscribed to the Gray Capital YouTube channel, or you are getting the podcast. If you're listening to the podcast, watching, just looking at Jerome Powell, answering some questions from reporters about the most recent decision to raise the interest rate of the Fed funds rate 50 basis points.
Mm-hmm. He got right to the point too. In his opening remarks, he didn't bury the lead. It was almost a foregone conclusion, was how quick he got to it.
Yeah, exactly. Well, and everyone knew. Yeah. I mean, it had been communicated loud and clear. Mm-hmm. They had been out front and center saying that most likely we're going to see a 50 basis point increase to the Fed funds rate, and as well as discussing shrinking the balance sheet. Yep. All with the idea of bringing inflation in check, taming inflation, trying to slow growth down so we don't overheat, so inflation doesn't impact more people.
So raising the interest rates 500 basis points, that's I can wrap my mind around 50, that. Yep. But then what about this reducing the balance sheet? And does that have any? So obviously, it's like, I know that has an effect on interest rates, maybe an indirect effect. But does it have any other effects in addition to interest rates? Does it make it harder for people to get a loan in the future?
I think it's a good question, and I mean theoretically it should, because what you're doing is removing liquidity from the system. I mean, the Federal Reserve has been buying billions of treasuries and mortgage-backed securities, agency mortgage-backed securities, really throughout the pandemic. I mean, I think there was 60 billion of mortgage-backed securities a month, and I think another 50 or 60 of treasuries. So now they've announced, and again, they just mentioned this, looking at reducing the balance sheet now by about $30 billion worth of treasuries every single month, and then about $17.5 billion of mortgage-backed securities. Now, the actual treasuries are going to increase to $60 billion after a few months, and then they're going to increase the sale of mortgage-backed securities by up to $35 billion over the next couple months. In addition, wow. This is just another tool that they can use because they've got a couple tools. One's just moving rates. One is buying assets, buying bonds. And those mortgage-backed securities, those are loans for real estate.
Yeah,
or, mortgages. And so not only they're going the other way, it's not like they're going to just stop buying, but they're actually going to be selling off. So there's going to be less liquidity. They've been the largest buyer of these mortgage-backed securities. And so that for the lenders who are actually making these loans, if you always know you've got a buyer, it's easy to make the loans. But if you're not sure if you've got a buyer, and in fact, you've got the biggest buyer who's selling right now, that can decrease the amount of liquidity and make just less money available for loans. You can't get a loan. You can't do a business venture. That has a result of slowing the economy.
Yeah. Okay. So banks then, faced with that problem that they don't have the money to give the loans out.
Potentially. There's other buyers out there in the market, besides the Fed, but they've been the largest buyer for the last about 2 years or so.
So then, as a solution, supply and demand, then they either raise the rates.
Well, it's driven by market forces. So when you have somebody selling something, the price of the value of like a bond is inverse to the interest rate. So when you're selling something, that price is going to go down and down and down. And that means the interest rate is going to go up and up and up.
Yeah.
Because if they need to incentivize someone you want to have get a higher interest rate if the value of something is relatively lower.
Okay.
So theoretically the interest rates on mortgage-backed security on mortgages will continue to go up. Now, most of those mortgages are based off of the 10-year Treasury or indexed to the 10-year Treasury, which, as we're seeing at least right now, was hovering right around 3%, which is a full 100 basis points more than it was just a couple months ago.
Yeah.
And so I think it's important just to make sure that everyone knows about what we're talking about in terms of interest rates being moved, because I know for a lot of people, they think the Fed controls all the interest rates, and they really only control.
Just turn the dial up.
Yeah, they're like, let's just turn it all up. But the only interest rate they really control is that the Fed funds rate, and that's like one of the shortest term financing rates, and they have less control, really, not as much influence over like the longer dated maturities, like the 10-year Treasury. That's more market driven.
Okay. And
that's why we've seen, the 10-year has already, a lot of the movement has already been priced in. And so that's where we went from 2% a couple months ago all the way up to 3%, where we were at, 0.49% in the 10-year Treasury back in 2020.
Yeah.
So that's different from that Fed funds rate that basically kind of sits there until the Fed moves. But then that gives room for all the other rates to move up as well.
Okay. And then so just to kind of circle back to the asset purchases, then if they want an effect on the other rates on the 10-year maybe, is that what these asset purchases are meant to kind of indirectly move, or is that?
I think it's in general. I think that there's a lot of talk, especially in 2021 or 2020 and 2021, about like yield curve control, where they're really trying to affect like the longer end of the curve by buying more 10-year Treasuries or selling 10-year Treasuries or whichever dated maturity they're trying to influence, because they can be such an influential buyer.
That makes sense.
But I think that's not as much the stated goal as we're just trying to slow down the economy in order to slow down inflation.
Okay.
Now there's some takeaways. I made some notes while Jay Powell was speaking, and just I want to kind of go through some of them. So we mentioned the reduction in the size of the Fed's balance sheet, but also looking out in the future for future rate hikes. They are going to be contemplating additional 50 basis point increases to the Fed funds rate at the next several meetings. Steve Leisman asked if they were considering, from CNBC, asked if they were considering rate increases beyond 50 basis points, maybe 75 or a full percentage point. Jerome Powell said that rate increases at 75 basis points or more are not currently being considered. The only thing being considered are 50 basis point increases, but all those decisions will be made essentially in real time at the meetings themselves, although they did quite a bit of signaling prior to this meeting. So they really want to get the market prepared, not have it to be such a, they don't want it to just snap one day, rates are going to increase, even though that's the case. They want the market to be able to price as much as that in, so it's sort of a soft landing. So 50 basis points potentially at future meetings. They really want to get inflation down to 2%, of which is their target. But he said that there could be further surprises with inflation. They're going to be nimble. But he has highly attentive to the inflation risks in the economy.
Seems like he really led with that.
Yeah.
Whereas before, maybe he wouldn't have mentioned, but they've got a target. It's 2%.
Yeah.
And it's not this, last year we heard this talk about, no, it's really like a moving target. Yeah. But they seem.
Well, they hit their average now.
Yeah.
Because that was giving them room. Now we're averaging a little bit over.
Yeah.
And does that mean they need to go negative now to get the average? But what we've talked about a lot is it all depends on what period you're using. Because if you go back 10 or 12 years, well, we were kind of below 2% for that quite a long time, but maybe that's in the past and doesn't mean as much anymore. I think is a really good point, and this is kind of sort of transitioning back to multifamily. The whole reason that they are doing this, can do this, is that the economy, and this is a paraphrase, but a near quote. The economy is strong enough to handle this tighter monetary policy. The only reason why we can do this right now is because the economy is so strong, is on such solid footing.
That's a good point. Yeah.
The labor market is tight. Wages, we're seeing the highest levels of wage growth that we have really ever seen, which is very positive. We still have very strong household and businesses are in very good standing. And so the idea here is that they're trying to find that soft landing, or as Jay Powell said in the press conference, hey, maybe a softish landing, maybe not soft, like super soft, but like soft enough. Yeah. And what we've been talking about, Matt, is it's easy we could see a recession, but is it going to be a recession of the real economy, or is it going to be more of a real technical recession?
And in some more of the articles that we cover this week, there is really some great signs that we've got a lot more armor this time around than we did during the Great Recession.
Yeah.
And there's a lot of great things that are going on in the economy. I just think it's almost like we've got to balance the books. What I noticed too specifically was, Jay Powell was in this awkward position of having to talk about job creation as almost like a problem. And he's like, I'm promising job creation is going to go down.
And then wage growth.
And wage growth coming down. And which is, if you're an employer, the tight labor market is a problem. But it's just hard seeing that in the same sentence. And he did get a specific question that asked, well, you're going to lower job creation. Is that going to mean there's an economic downturn?
Yeah.
And he's like, well, and that's what led him to say, it's going to be a little bit of a rough landing.
Yeah, he's like, it's not going to be easy.
Yeah.
He's like, this is not going to be easy. But can we get through it where, again, like on a technical basis, recession, 2 consecutive quarters of negative GDP growth. We've already had one.
Yeah,
we've already had one. But again, a lot of people, it's kind of a nuanced understanding of it. But if you look at why it's negative in terms of, we're looking at a base effect, that we had incredible growth. You don't necessarily want to continue the same levels of growth. You want a little bit of normalcy, and you can't get to that level of normalcy without some kind of reversion. So that's going to require maybe a little bit of negative growth to kind of get right there in the middle and the sweet spot.
Yeah.
And so the question is, we could easily be in the recession that we're all worried about. Could already be here. I mean, the stock market is, tech stocks are some down 50%. The broader market I think is down like 30%. So we've already seen, in public equities that all already occur. We're in a bear market for bonds. And we're seeing negative GDP growth. I'm not saying it's going to be exactly like the pandemic recession because we had all the layoffs and there was even more disruption. But I'm wondering if we could see no recession is completely pain-free or painless, and there's still a lot of people that get damage and it's not good. But is this kind of, we had the snap recession at the beginning of the pandemic. Do we need just one more kind of quick recession, even if it's just a technical one, before we kind of flush out the volatility and the noise out of the system so we can return to some level of normalcy, even if that's elevated growth and looks different than it was pre-pandemic? But do we need one more kind of reshuffling to get to the other side? And so the question for us is, how does that affect multifamily apartments, real estate, and for any investor, how they're going to allocate themselves in this type of environment, because it's uncertain.
Yeah, no, I think that seems to be the big takeaway is if you have to wait on every eyebrow raise of Jay Powell, during these meetings and try to predict things, that's an uncertain environment anyways. You don't want to be in that situation. And hopefully they want to create a predictable environment, and that's what's a little bit better for investment. But I will say, the amount of savings that individuals have and that the economy has is at an all-time high. And so that could be a really, you could lop that off. That's giving people cushion. Maybe that's why we aren't seeing so much more of a reaction, so much more like anxiety and alarm bells. People are kind of calling for it, but it's not hitting the headlines. People are talking about inflation. They're not talking about, stagnation. So maybe that's because there's just more of an economic cushion with that savings.
Yeah. Maybe a little bit there's more stagflation talk, I guess, these days, but the economy seems to be really continuing to cook as things open up. But they're all kind of external factors that we have to be looking for that you either could continue to drive inflation or not. I mean, China locking down. I mean that's one factor. Obviously, the war in Ukraine is another major factor that we still don't know. But to me, it's just that there's so much clouded uncertainty. People just aren't sure what to do, if to do anything at all. And I think having a decent cash position isn't a bad idea right now. But we also have to look at some of those asset classes that are relatively insulated, that are opposed to outperform. And again, I'm really not just saying this as a major investor into multifamily and apartments. I've kind of done a reassessment of all right, what are the conditions right now? What's the new thesis? Because we're in a different world than we were, 6 months ago, 6 months before that. It keeps changing. The short-term conditions are changing. Not a lot on the long term has changed. And in fact, some of the long-term changes or the big macro changes are even more beneficial to multifamily, and I see continued performance. Now, how interest rates are going to affect transactions, that's a slightly different story. That's more of a near term. But looking at a long-term hold, you still see some really positive fundamentals.
I agree.
So, and maybe let's just lead that into kind of the first report. This is from CBRE. Economic Watch. Real estate fundamentals expected to improve despite Q1 drop in U.S. GDP. Matt, this maybe surprised a couple of people that real estate is actually looking good with rising interest rates, reduction GDP. What's going on?
This really stands in for a collection of articles and a collection of takes that I've gathered in the past week about the slower economy as indicated by this negative GDP number of 1.4%. Really, for a dismal figure like that, you'd expect a lot more anxiety and more discussion saying that, well, this proves that the economy is going to be bad. But instead, there's a lot of a lot of examination of the number itself and a lot of reasons to be a little bit more optimistic than a negative number would otherwise imply. More common, really, are headlines like this one from Forbes that says, negative 1.4 GDP just reminds us of the abject stupidity of GDP. That's my favorite line of logic, by the way. I don't like it, therefore it's dumb. But there are reasons that maybe it's a little dumb. I do think it may lump a lot of things together that if you look at them separately, you can kind of explain things in a way that doesn't necessarily mean all negative. Employment and wages are going up. That's what, we've got this situation where the Fed is actively trying to cool down the economy. So that's a sign against this negative number in and of itself. I think that consumption grew, certain areas of investment grew, but on the other end side of the scale, as a CNBC article puts it, complications in inventories and international trade dragged the whole quarter down. There's kind of some export-import imbalance, and there were certain private investments that went down. And also, in a more general level, the idea that the U.S. is recovering at a faster pace than other countries is hurting our GDP and kind of contributing to that out of whack. Export,
well, I know the strength of the U.S. dollar, I know, isn't helping that trade imbalance either. You want to kind of get into breaking down some of the different asset classes CBRE does in terms of the strength?
Yeah. So I think it's interesting that they're a little bit more confident about office as COVID concerns recede and then reopening. Retail is also going great. There's another article or another short video that we're going to cover that talks about how some investors are moving into retail because it's got high cap rates and it's a promising market. I think industrial is also, positive outlook. It did amazingly well during the pandemic, and even now even though I think that Amazon posted didn't do as well as they thought, but I think that may not be the full story when it comes to the industrial market. And multifamily, obviously, coupled with a robust job market, higher mortgage rates, and less single-family affordability, this will bolster demand for multifamily. You're going to see that again. This idea that high mortgage rates and single home affordability is moving people into multifamily. This is something we said, and something that this statement almost verbatim is in like several of the reports that came across.
I mean, that's the thing to me it's kind of a pretty no-brainer and very obvious connection to make, because you have a lot of people. I mean, household formation has gone up and people are looking for a place to live, but there's a lot of people who just can't. There are more renters by necessity, not that they are not well off, but they just can't. They don't have the down payment to buy a home, or that they maybe do, but they're just a little bit more cautious and they're not feeling as strong about buying a house, maybe at the top of the market and paying a high interest rate. And they're saying, well, I'm going to delay that decision or maybe rent for at least another year. And then it's also just the people who actually can not afford to buy a home. That percentage is even larger, that renters by necessity, and occupancy rates are already at an all-time high, vacancies an all-time low. So you're not going to see higher rates of vacancy with increased demand and a higher, resident pool. I mean, tell me how that would work. And so what's that going to do? Higher occupancy leads to higher rent growth. And that's also corresponding with increases in wages that will support some degree of rent growth. And
so I wonder if this is going to increase. So I'm kind of skipping ahead, but there is a relevant little research brief really by Marcus and Millichap on housing, and they predict that housing in more expensive Class A properties, that demand is specifically going to go up. I kind of think it's going to go up across the board. And specifically, people that want more space, more square footage, maybe they are getting 3 bedrooms instead of 2 bedrooms, and that may happen, in B class. Like, I think that it's really interesting to see. And again, this restated position that mortgage rates climbing are going to push demand. I think it's definitely more than just into luxury apartments. I think everywhere, no matter what side, it's gonna be higher demand. It's not just the wealthy lifestyle.
So Matt, it's not as though people living in call it C class or B class community, you could easily say it's like, look, yeah, maybe their wages have risen a little bit, 3%, 5%, but they can't afford the 15%, 20% rent increase.
Yeah.
I think that's true. And so what you're going to see is people not necessarily staying at the same property, but they're going to be moving down in class.
Yeah.
And so you're going to see the people who were living at maybe A class, maybe move down to B class, the people who are going to be buying a home moving into A class. And so you see this kind of like shift downward, in a recession as things tighten. And then as the economy expands, you kind of see a shift upward, hopefully, of people moving up in class.
Yeah.
The people who are living in the C class assets moving into a B class asset, people living in the A finally buying a home.
What I wonder is if a 3-bedroom, a Class B apartment is going to have more competition for it than maybe a 2-bedroom Class A apartment, just because there are people that are, expecting home. They have a family, they want that, but then they're kind of waiting it out, or they're unable to for whatever reason. Yeah. It may drive a specific floor plan, more than others.
I think you're right, and it's so different from a couple of years ago because everyone didn't want the 3 beds. They'd be like, oh, there's a lot of 3 beds here. Because you get a lower price per square foot on your 3-bedroom units. Usually your studios, you're getting the highest, per square foot. So you're making more economic use and more profitable overall as a property. Multifamily, we don't always we look at it per square foot, but it's not always like the driving metric. We're looking at it per unit. But there's so much demand for the 3-bedroom floor plans, and there's only a small percentage of those. A lot of properties don't even have 3-bedroom floor plans, and I think that you could see some 3-bedroom at a B class being more expensive than a 2-bedroom at an A class, all depending, I think there's a couple other factors that might influence that, but there's only a handful of 3-bedroom apartments in a market. Yeah. I don't see why they wouldn't be able to get a pretty nice premium for that. And we're seeing that already. So
and accompanying all this talk of demand, there is still a supply issue, and that's something that to keep in mind is we're not building the rate, or really even as another one of these reports, the ratio of multifamily units to single family homes that we should be building. So that's just another thing.
It's going to be fascinating. So, do you want to go back to the other Marcus and Millichap?
Yeah, let's watch that video for sure.
We're on the Marcus and Millichap chain. We're a little bit out of order.
Again, there's like so many times where I'll research all this stuff. I'll get a kind of sense of the issues that I want to talk about, and then I watch a John Chang video who does it perfectly in like 5 minutes.
So just summarize, since we're not going to play the audio of John Chang from Marcus and Millichap.
So this is really a video that's based on a conversation he had with 3 industry professionals, really kind of expert brokers from several different property types.
Okay.
One of them, a multifamily broker based in Florida, has marked, 3 different property types, and they're all talking about whether CRE investors are going to sit things out, or what are these investors interested in. And one of them, a multifamily broker based in Florida, has marked a shift away from apartments and into alternative properties with higher cap rates like retail. Yep. There's another one that says that, I'm a retail, and retail's doing pretty strong as well. And one of the reasons is this highly competitive apartment market has investors squeezed between low cap rates and high interest rates. Yep. And that has led to lower investor demand. And again, I'm going to come back to this point later, specifically because there is this idea of people sitting out, of lower investor sentiment, that we'll see in an NMHC report in just a second. But then there was really 3 takeaways for that John Chang had, and the first is really, I think, maybe the most interesting, is that increased jobs numbers and savings have investors that are looking at the long term, because that's what CRE investors do. They have them more confident than not when it comes to the economic future and the future of the commercial real estate market in general. He said, for the first time in 30 years, U.S. households have more cash savings than debt. I think that's a big deal. I think that you can't...
There's more cash savings than liabilities out there.
Yeah.
Wow. That's fascinating.
And because it's a ratio, I don't think you can really discount this whole thing because of inflation. I think, yes, you'll haircut all those savings a little bit from inflation, and that may give it more momentum specifically. But man, passing a debt threshold that is lasted for 30 years, I think that makes me feel like not all of this wealth is going to be eroded by inflation.
Yeah, we've got some headroom.
Yeah. And John Shank's second point is that investors have a lot of assets and property types for investment in commercial real estate, and I think more relevant for multifamily investors, that there are a lot of locations, a lot of markets to choose from, more places really to look should investors be dissatisfied with lower cap rates that can be found maybe in the competitive market. And then finally, as I alluded to before, CRE investors are looking long term. I think that it is promising, at least in his conversations with these brokers who are seeing a lot of investors, each individually, maybe that's what their opinions represent. They've got their eyes on the horizon, and they're a little bit more confident about the long term than these short term things like raising interest rates or GDP that may have people scared. But I would happen to agree with this opinion rather than some of the other. There are some elements of sentiment that can swing a little wildly, and I'd hold tight on any doubt that you might see currently.
Yeah, I think the biggest question that I'm getting is, what will cap rates do with rising interest rates? And I think that's a good question now that we've learned that cap rates and interest rates aren't pegged to each other. They are correlated, but they're not. The correlation is a little bit more wishy-washy than I think many people believe that they are, because there's so many other factors. I mean, cap rate is a depiction of the last year's performance, not over the next couple of years, the future performance. And with high levels of growth, the cap rate means less and less and less, and even your interest rate, you're maybe paying higher, but if you have a high rate of growth, it doesn't encapsulate the entire return profile and expectations for an investment.
Yeah.
And so I think a lot of people are they're concerned that the cap rates might rise, but that doesn't mean necessarily values are going to decline, even though cap rate, properties are valued with a cap rate. But again, but what is NOI going to look like? If you're seeing strong NOI growth, which is the numerator in that equation, you're still going to see flat, if not positive, growth. And we haven't seen, even though it's a little counterintuitive, we're going to look at the NMHC survey here in a minute, talking about kind of investor sentiment, developer sentiment, availability of equity and debt and all of that. And people are not as optimistic about, there's not as much equity out there, but people are still buying real estate. I mean, just from, again, anecdotally what we're seeing in the market, there's still a lot of interest. There's a lot of dry powder that's still out there. Definitely more caution, though. I mean, we definitely, especially from more of like the individual investors, it's uncertainty. They're just not sure what to do in general. And they're just like, I don't know if I want to do anything right now. Which I don't think is an unreasonable position, but you may just miss out on those opportunities. But that's okay for some people. They'd rather just not take the risk and miss out on the opportunity.
I think if anything, and this is kind of leading into this discussion of the NMHC survey, is that apartment investors may be shying away from these low cap rate growth markets. They may say, I don't think it's going to keep growing. And so even if it has a cap rate or
it's just gotten over its skis a little bit. It's gotten so crazy. And I'm thinking, and that's exactly, I was going to say this, Matt, when you were finished, and not to cut you off, but we are already seeing this with some buyers that were in the Sunbelt, in the Phoenixes, maybe in Atlanta or Tampa, wherever it might be, some of these really high growth markets that have seen a lot of growth, incredible amount of cap rate compression, prices increase, and the cap rates just don't make sense, especially with rising interest rates. They hardly made sense when you had interest rates kind of in the mid twos. And so they're looking for stable markets that just weren't bid up, that kind of make sense. And they're seeing the Midwest as that safe haven and that opportunity in a greener pasture. And we're already in the Midwest, so we're seeing new buyers coming in and a lot of interest, a lot of institutional interest. And it kind of is at a sweet spot where it's like you've got some markets that are still growing, but you can buy them at decent prices. I think that may be, for really the opportunity for right now.
Yeah, there's a powerful narrative that's still going on about the growth of these Sunbelt markets. Yeah. It just may not make sense with the percentages that you're going to get from the cap rates in the market.
Yeah. All right, so let's move on over to this NMHC survey, quarterly survey. They do it every quarter. NMHC quarterly survey of apartment conditions, April 2022. So they they do a survey of large apartment owners and developers. Here, let's see. I'll just read how they do this. The report index numbers are based on data compiled from quarterly surveys of NMHC members. Survey responses reflect the change, if any, from the previous quarter. So let's look at what they're asking. Market tightness, how hard it is to win a deal. This goes all the way back to January 2018. So right now in April, the market tightness index is at 60. The higher the number, the more tight it is. The lower the number, the less tight it would be. And then, one good comparison, if we go back, just as a counterexample, is early on in the pandemic, in April of 2020, it was all the way at 12. It's like it wasn't tight because no one was doing anything.
Yeah, that's a real low point.
Real low point. And then in July of 2021, it was, a 96. People are saying it's as tight as pretty much it has ever been. And it was the tightest that it has been since they started tracking this. 96 that's very tight. That makes sense because we were trying to buy deals in that period.
Seems like 60 is a pretty good number.
Yeah, pretty healthy. But it's like it was in July 2019.
Yeah.
Which was kind of similar times of interest rates.
Outside of that, though, that's there's no time before July 2019 where it was above 60. So it's still relatively tight.
Yeah. So sales volume, decent amount of sales volume, although it's coming down a little bit from July 2021. Again, back in April 2020, it was all the way at 6. So nothing was trading back then. The two questions that I found the most interesting and had the biggest changes, though, Matt, were the equity financing index and the debt financing index. So right now, in April 2022, they had the equity financing index. It's just like the availability of equity out there in the market. It's at 35.
So equity, like how interested are investors?
Exactly. Yeah, for equity investors, not lenders, but they're putting risk equity into a multifamily project. This could be institutional. This could be retail. This is probably more institutional. So it's at 35. We haven't seen 35 since July 2020, which was 34. And then it bottomed in April of 2020, which kind of makes sense because everyone was just pumping on the brakes. So, the whole world had stopped at that point. And
pre-pandemic, it's still low. Like 35 is a low number. It's usually around 50s or maybe even kind
of in the mid 50s.
Yeah.
Before that, people were like, yeah, it's out there halfway. Yeah, sure. Yeah. But then the big change, I guess, was in again April 2021 and July 2021, where there's just a fervor to buy these assets for good reason. But that has cooled, I think, really with just all of this uncertainty. Then the debt financing index. Again, this is entirely related to interest rates because there's still plenty of debt out there. The agencies, they haven't even come close to hitting their quotas. And back in it's been loose monetary policy. It started to tighten up here in January. It seems as interest rates had risen a little bit, not much, but the 10-year had started to rise some. But this is compared, to let's say in even January, or where's July 21? 71. I would even think that would be higher. But it has been kind of moderately kind of throughout. It decreased in April of 2020, which is interesting because even in April of 2020, so there were. This is what's surprising is that. The CMBS markets kind of froze up. There wasn't a lot of CMBS. I don't think there was any CMBS lending going on. A lot of because we won a deal, but someone was trying to close a CMBS and the financing went away. We were able to pick it up. A lot of bridge lenders just got out of the market. Not all, but many got out of the market. Today, CMBS is still active. There's plenty of bridge debt. There's plenty of debt funds. The only difference is interest rates. And that's the effect. Bring it to a 9, which is, I believe, is the tightest or the lowest it's ever been on record. It's never even been in the single digits before.
Now, in 2018, is that the year of the taper tantrum?
That's when they were rising interest rates.
Okay.
Yeah.
So those rising interest rates brought it down to the lowest was 22. So 9 is a lot less than 22.
Yep. Now, and again, and Matt, you had mentioned this earlier. These aren't like scientific numbers. This is like 100% measuring people's general opinion about things.
That's why I thought I have a little bit of skepticism. I'm actually not that surprised about the 9 figure, because that's what people are thinking about. This is all this is for the first quarter, and there is a discrete real a real fact that's behind this. But the idea that this equity is unavailable, that's surprising to me, and I don't know how much I trust it, because it runs counter to this idea that there's so much dry powder out there, and I don't get, I can't reconcile that. It's kind of difficult. And my first explanation,
maybe the dry powder's out there. Well, here, go ahead.
So my first explanation, and I really came to this last, but it's a boring explanation, that rising interest rates can bring down returns, and when investments have lower returns, people are going to be less interested in investing. You got to change your business plan or find a lot better deal, and maybe that's what's driving off investors.
See, I think that it maybe plays a part of it. I think though that returns are important, but people often, they are important, but people are most often investing into a story and based on feeling. As much as we crunch the numbers and the numbers are important and the returns are all that, you got to have all that. That's important. But that's not why people invest in something. People invest in something because they've got a feeling about something. They feel good about it. It feels right. They like the group. They like the idea. They like the story. People invest in narratives. Yeah. And the narrative right now is, uncertainty, inflation, war, rising interest rates. We just don't know. There's noise, and through clouded minds, confused minds can't make decisions. Confused mind says no. And returns are, let me put it this way. I haven't had a conversation with an investor recently where they're like, oh, yeah, the returns are just too low for me. Even though the returns are lower than they were previously, at least cash on cash. The IRRs are penciling out about the same. Because they kind of get it. They're like, okay, yeah, the cap rate's a little bit lower, interest rate's a little bit higher. I get that. No, but that's never like we haven't heard that those returns are just are just too low. But what we're hearing is it's like, it's just hard to make a decision right now with all this other stuff going on.
See, and that's what kind of surprises me, because, John Chang just told us that CRE investors have their long-term horizon. And, we always talk about the robust, we're not going to be scared. We're not going to go topsy-turvy. But I think that there is a little bit of an effect. But my point is, and I feel like, yes, there are many macroeconomic trends that could generate this feeling of uncertainty, but on the micro level, I feel like if a syndicator pitches an individual apartment deal to investors and the numbers look fantastic and stand up to scrutiny, I think there are still plenty of people out there that'll invest.
There are, and there are for sure. Good opportunities will still, win the day because you have that long-term mindset. Just some investors get that and they understand the long-term, and some have a hard time. You can even say that you get it, but sometimes it's hard doing what you say.
Yeah, and maybe the story that could run counter, like we've tried to say before, is certain markets it may be true where things are running so hot that the numbers aren't making sense and the growth's not going to be there. Yeah. But other places it may be a story of stability and resilience. Amidst a whirlwind, this kind of island of stability.
Yeah. Accredited investors can go to Gray.fund to learn more.
That's exactly right.
So let's pop into this real page piece, Matt. Again, this NMHC survey, the difference, again, a lot of that kind of hefty grain of salt on these numbers, but the big difference I thought was quite interesting. So real page. Multifamily construction climbs in March as single family home stalls.
Yeah, this is just a little short post on the Real Page Analytics blog, and I think this is an interesting development within the past few years, actually. So it's talking about how multifamily construction has surpassed single family construction, and that's a little bit of a headline. But if you look at the chart that they have, multifamily is typically above, and for years and years, as this chart indicates, multifamily permitting has hovered above single family permitting, and only really since the pandemic has single family outpaced multifamily, and only for a short while. Basically, I think that we're returning to normalcy in a way, and multifamily has a little bit more room to grow. I don't think that it's that much of a story of something unusual happening. Maybe something unusual is ending.
Just kind of going back and forth.
Yeah.
Well, that makes sense, and it kind of it further makes sense when you understand that there's going to be more renters out there.
Yeah. And that's what I was going to say too. It's like the easy story that I thought of at first was, without seeing that chart, is like, oh yeah, of course there's going to be more multifamily permitting because of this mortgage situation and the cooling growth of the housing market. Yeah. But also I think typically it's just returning to the mean.
Yeah. So apartment list, national rent report, apartment list puts some decently high frequency information out, kind of covering where, and they do a lot of kind of granular, more local, market reports as well that are really good. But Matt, what's the headline over here at an apartment list?
Yeah, so they say that rents are up by about 0.9% last month. To put that in context, if you have a full year of that amount of monthly growth, you'll get about 12% rent growth, maybe plus or minus. Yep. Additionally, this monthly rent growth is higher than what was measured in 2019 and higher than really all but 1 month in 2018. At the same time, this 0.9% increase is a little bit lower than the 1% inflation. That's kind of surprising, and I wonder if this is going to fuel more rent growth, or what's the feedback loop there. If inflation is going to erase all of this rent growth,
or erase the rent growth, or continue to drive it, or to finally put a kind of a damper.
Well, I'm sorry, not erase, but basically outpace it. So if rent growth, and this is good for renters, but not necessarily good for investors. If inflation is increasing it faster than rents, that might be a problem for investors. It makes it a little bit less profitable.
Potentially. It really hurts the consumer as well. Now, if inflation is really outpacing rent, which doesn't usually happen, rent typically outpaces inflation. I guess in that inverse, the renter's saving a little bit more, not having to pay more rent, but typically that means that there's move to move rent up as well. Really, the big question is if, as interest rates are rising, does that decrease investment? Businesses stop hiring, and people potentially lose their jobs.
I think it may be more likely that we'll see a little bit of a lag in rent and inflation. Maybe next month will be higher rent growth because of the inflation that was experienced earlier in earlier months.
Well, and you see, it's obviously, the rental season is highly seasonal. It's every single year you have strong rent growth in the spring and the summer, with July being kind of peak. Every single year July is almost always the peak. Even in the pandemic, it was the month that we actually saw some rent growth on a national basis. But we're already kind of outpacing what we would typically do on a normal year. We're going to see if we have an insane May, June, and July, and August, or if it's going to be kind of more typical to past years.
Yeah.
And so far, again, this comes back to the issue of occupancy, and again, the availability of single family homes and mortgage rates. And if you have more individuals deciding that they're not going to buy a single family home, they're going to decide they're going to rent, they're going to stay renters. You have more renters created every single year as people get over, kids they graduate from college, they need a place to stay. And if people aren't kind of getting and moving out of the apartments into single family homes, they're staying in those apartments. They're filling them up even more, and that's going to increase rents. Just because if you're 100% occupied, you have one unit available. It's like, well, let's see what I can get for it. Who wants it? There's one person out there who'll pay $100 more.
And that's what this report does, give a little bit of a clearer picture for vacancy. I think that the story's still out there. I think that there's still some unknowns when it comes to rents, but I could see the vacancy seems a little bit maybe more stable. It's at 4.6% currently as measured by apartment lists, which is below historical norms, which is good, and doesn't look like it will get back to pre-pandemic levels for some time, given the lack of multifamily supply and the consistently high demand for apartments. It's really coming at it from all angles.
We shall see. So this is just another way of looking at rent growth or breaking it down each year. we're kind of right. I mean, we're kind of tracking more normal than we certainly were last year.
Yeah.
So I think that's I think that's definitely interesting. Although above where we typically are, but not nearly as where we were in 2021, and that makes sense and is kind of a good thing. Matt, to your point, looking at the vacancy index, really low vacancy. I guess we bottomed out at 3.8 in 2021. The question is, will we see similar levels? And that immediately corresponds with that incredible rent growth.
Yeah.
Occupancy really kind of topped, vacancy bottomed, and rent growth really pushed in the mid to late summer. We'll have to see.
Well, it was 6.4%, in 2019 in April.
Yeah.
So who knows? I think that that to me implies that'll drive rents up further.
Yeah. So, Matt, still been trying to figure out this color graph. Obviously, I mean, I know it's rent growth, and the colors are ranging, plus 3% or more, or minus 3% or more. I don't understand this though. A lot of red in 2021, and not as much red so far. But we were only just in the beginning of 2022.
Yeah, I think when it comes to markets, the slowest growing, and this has been the same for the past months and for a long time, is San Jose and San Francisco.
Yep.
And really, you see a lot of slow growth in Minneapolis. That's the other one. There are these
Minneapolis
traditionally high cost markets like San Francisco, San Jose, and Washington D.C., but then nestled in them there is Minneapolis. It still has a lot of time to go. Yeah.
And then there's a handful of Midwestern markets that are growing. They're just not growing as fast as the rest of the country. So, interesting. Rent estimates, who knows what we're going to see. I mean, -5% to 40%. It's an incredible range. I'm sure a lot of these 40%. I mean, Clearwater, Florida, since March of 20, 42% year over year. Right now it's 27%. Month over month, 1.4. That's bonkers. Miami rent growth since 20, 29%. Month over month, 1.4. Incredible. Now, to your point, Matt, let's look at Minneapolis. Oof, if I can get on the right. Oof, net -5% since 20. That's just rough. That's rough. But let's look at maybe like in Indianapolis, 18.2% since March of 20, 1.5% month over month rent growth. That actually beats some of those Florida markets, man, if I'm not too mistaken. And then looking at Carmel, 29. And so this is where people miss out. And why we like Indianapolis is there are all these little submarkets that are just on fire. This is, you're getting Sunbelt level rent growth for Midwest prices and Midwest cap rates. 29% since 20, and there's more than one. Greenwood, 26.9% since 20. Down here in Bloomington, it's 17. That's not bad. But a lot of good growth. Evansville, 19%. Fort Wayne is 22%. South Bend, Mishawaka, 22%. A lot of good opportunities around the Midwest. Lexington, Kentucky, 20% since 20. 1.5 month over month. That's really strong. And so again, Florence, Kentucky, a lot of really just solid growth in a handful of markets. Memphis is doing really pretty well. Beginning, you got your New York City's not doing that great in compared. 9.7. We shall see. And again, what everyone sometimes misses, and most people are a little bit more up to date, is the difference between market rent growth and the difference between the current leases and that market rent, and how long it's going to take to absorb that growth, because you don't flip over all the leases to the new market rent just in a day. It takes time, because you typically on renewals you're raising those increases at a much slower rate. Your new market rents may be 20%, but the renewal rates may only be 5% or lower. And so it takes time to turn those over. And so you're going to have baked in organic rent growth in multifamily over the next couple of years.
Yeah.
And so that's something that shouldn't be ignored to prospective people who want to invest into multifamily is that there's a lot of upside that's kind of baked into a lot of this.
Yeah, and if you find that submarket, there's a lot of people that are really hooked on that idea, and investors flocking to places like Phoenix, or Miami or Tampa, and they're really maybe over predicting, and that's made it incredibly competitive. But those opportunities are still in other places. There are light color, red zones within a larger maybe blue.
Yeah.
Blue cold.
And so what they're saying is, okay, well, we're not going to basically get any cash flow because the capital rate is so low, and we're having to pay such a high purchase price in the first year, 2 or 3 years, and eventually we'll squeeze out some cash flow near the end, but then we're going to sell it for a ton because we've increased NOI, and we're going to sell it a low
or sell for a ton because rents are still going to keep growing just like they did in the past.
Yeah, but if you think you can just factor in just continued rent growth year after year after year, you can find yourself in a bad situation pretty quick, especially if the music stops all of a sudden and you haven't set up your investment to hold long term. That's why in the past I wouldn't have a problem using a bridge loan, but right now having to sell or refinance in 2 years, that makes me a little bit nervous. And again, it just opens up a degree of risk that wouldn't be present otherwise. And that's where it's like, well, we can put on, 10-year term loan. Again, it gives us just so much more flexibility. Now, albeit your potential returns are going to decrease, but also the risk of loss decreases significantly. Also, not that a lot of people lose in multifamily. It's certainly possible. I think that the default rate is under 1%. So very few of these projects fail, but your risk is really underperformance. Typically, I mean, the real risk is total loss of capital, 100%. To be clear, but usually when a project doesn't go well, just the return is not as good as you think, and that's fortunately, surprisingly, not too common, but it certainly does happen. That's why it's important to be partnered with the right group, right operator.
Yep.
All right, if you'd like to learn more about multifamily investing, the industry, real estate investing in general, make sure first you've liked this video, you've subscribed, you give us a comment below because you may have seen on previous videos, if you give us a good comment, we will feature it on the next episode of the Gray Report, give you our take, and really talk to you about it. So we'd like to interact with you all, so make sure you leave that comment below. You can reach out to Matt or I on LinkedIn. We're relatively active there. But if you'd like to learn more about actually investing with us in the Gray Fund, if you are an accredited investor, you can go to, just type in your browser, gray.fund to learn more. But I would be amiss to not mention, if you are not getting the Gray Report newsletter, I mean, Matt, we've had some incredible reviews and testimonials about the newsletter and the Gray Report YouTube and podcast in general. But man, we've gotten some great feedback recently. Some people saying that it's their go-to source. I mean, not just telling us that, but it is their go-to source that they are feeding for their entire business. It's a true intelligence aggregator.
That's what we try to do.
And it's so awesome to hear because we just started doing this. I remember getting together let's do a newsletter. Let's start gathering information because it's not disseminated well. And we're okay, sure, we can put these articles together, and you've just totally crushed it and done a great job every single week.
Thanks.
And again, we kind of started doing it for us in a way, and maybe people would be interested. But now to hear people who are in the industry that that I really respect saying no, this is my go-to source for any kind of information on the multifamily industry. And so just a lot of great feedback. Again, much of the credit is to you, Matt. So
if you don't like it, you can comment on this video.
Exactly. There is options for regress.
That's right.
So catch us on the next episode of the Gray Report. Make sure you're signed up to the Gray Report newsletter, graycapitalllc.com/newsletter. You can always check the updates every single day, grayreport.com. And again, if you are a multifamily investor that is accredited, hop on over to just gray.fund. Let us know that you're interested. Looking forward to talking to you soon. My name is Spencer Gray. We got Matt Bosnagel. Catch you on the next one.